Okay, today, uh, March 18. Okay, let's start reading articles. Okay. Hmm. So, three reasons to buy Hormel stock like there's no tomorrow. Hormel. What is Hormel? Hormel has been hit with several headwinds all at the same time. The company's fiscal 2024 quarter first earnings suggest the business is gaining some traction as it works to turn itself around. The stock has a historically high yield, a long history of regular dividend increases. Hormel has been struggling lately, but this Dividend King looks like it could be on the verge of a rebound. Dividend King Hormel is a food maker with a collection of industry-leading brands, but the company has been struggling lately due to inflationary cost pressures, avian flu, a slow COVID-19 recovery in China, and a weak nut market. However, green shoots are starting to show up in its business, which suggests the future could be trending in much more positive direction. Here are three reasons why dividend growth investors should consider buying Hormel today. Get in before Wall Street catches on to the story. Hormel has a long history of success behind it. None of Hormel's problems are permanent. Sticking with the dividend theme, Hormel has proven it knows how to persist through hard times while continuing to grow over the long term. Okay, anyway, I get that this is a food company. Mm, Hormel. Okay, I get it. What other articles do we have? Elastic NV. Mm. Why Elastic stock is a buy now? Elastic is up 80% over the last 12 months, but it's currently taking a breather with a 10% loss in 2024. So far, and it remains 44% below its all-time high. However, the stock is chiefly related to some of its peers in the AI industry based on Elastic's trailing 12-month revenue of $1.2 billion and its current market cap of $10.4 billion. It trades at a price sales ratio of just 8.5. The chart below shows how it stacks up compared to other popular AI stocks. Plus, the Wall Street Journal tracks 26 analysts covering Elastic stock, and 15 of them have given it the highest possible buy rating. One more is the overweight camp, with 8 recommending to hold, and one rating it underweight. No analyst recommends selling. Their average price target of $134.03 implies a 33% upside from where it trades today, but the street high target of $171 suggests that stock could soar 70%. Kathy Wood goes bargain hunting through stocks she just bought last week. Hmm. Tesla always been. Last year, Wood's benchmark art innovation fund climbed 67%, beating the S&P 500. But that may be just the beginning. Wood counts on holding on to her top picks for a long out to maximize gains. And this past week, she went on another shopping spree, picking up 3 bargain stocks that could roar higher. Tesla. Kathy Wood has been bullish in Tesla for quite some time. Electric vehicle giant represents the second biggest position in our innovation. Wood occasionally sells some shares of Tesla, but following declines, she often scoops them back up again. Hmm. Uh, this is because Wood and her team believe the stock could soar to $2,000 by 2027, representing a gain of more than 1,100%. From today's level, Tesla continues to work on autonomous driving technology and aims to launch a system of robotaxis. Chief Executive Officer Elon Musk has spoken of how Tesla owners could put their cars to work as taxis, resulting in income for them and for the EV giant. Of course, success here isn't guaranteed, meaning such a jump in the share price may not happen. But even if it doesn't, Tesla's brand strength in the EV market, including ongoing innovation. A recent example is the launch of the Cybertruck, and growth in other areas such as energy generation and storage still could lift the stock significantly from today's levels. Tesla has more than $29 billion in cash, means it has what it takes to invest in growth. So right now, this EV litter makes a great stock to buy on the deep. Moderna Toast. Okay, let's say Toast. It's a software as a service company offering a complete platform for restaurants. Through Toast, these businesses can manage inventory, handle payroll, process payments, and more. The stock may look like it's on fire in recent time, with the price climbing 28% so far this year, but the shares still are down more than 60% from their market debut back in 2021. So Kathy Wood adding shares to the Art FinTech Innovation Fund still could be getting in on Toast for a bargain price. And at the same time, recent share performance may be the signs of positive momentum driven by customer gains and earning strength. In the most recent quarter, Toast reported a 35% increase in its annualized recurrent run rate to more than $1.2 billion, a forecast GAAP operating income profit by the first half of 2025. Toast is gaining users, announcing more than 6,500 new locations using its services in the quarter to reach a total of 106,000 locations as of the end of last year. Though all of this is positive, Toast still faces certain challenges. For instance, it operates in an industry that struggled with higher costs in recent times, so some restaurant owners could favor less expensive alternatives. This means only investors with appetite for risk may want to follow Wood into this fintech player. Bill Gates' top AI stock probably won't be a surprise. His charitable foundation also has a stake in an AI innovator that doesn't view itself as an AI company. Valuation is a concern for both the AI stocks, but one should be a solid pick for long-term investors. Okay, here we have Amazon. The ultimate growth stock to buy with $1,000 right now. Multiple growth tailwinds should drive sales gains for Amazon. Management focused on driving efficiencies, leading to soaring operating income. Investors will still find the stock's current valuation to be compelling. This business proves that worthy investment ideas are hiding in plain sight. The Nasdaq Composite Index is in record territory. Hmm. While that's exciting news for some, it may be discouraging for those who have been on the sidelines. But don't let the market's rise keep you from seeking out compelling investment opportunities. There are still some quality companies selling at attractive valuations. If you got $100,000 right now, you're ready to invest, then don't look past Amazon. Here's why it's the ultimate growth stock to buy right now. Seizable growth potential. Amazon generated $575 billion in net sales in 2023. That's more than the GDP of some countries like Ireland and Thailand, and it puts Amazon behind only Walmart on the Fortune 500 list. To be clear, this revenue figure makes Amazon a colossal organization, but investors will be delighted to know that the business still has meaningful opportunities to expand. Thanks to multiple growth tailwinds, Amazon's business was built on the expectation of the expansion of online shopping. Today, nearly 40% of all e-commerce spending in the US happens on its website. 40% of all e-commerce spending in the US happens on its website. There's still a massive runway for online activity to take share from the brick and mortar shopping, which should lift the business in the years ahead. The popularity of Amazon Prime membership not only feeds into greater e-commerce sales, but it can also lead to Prime Video attracting more TV viewing time. Consequently, Amazon also benefits from the streaming trend. Then there is digital advertising, salmon that rate in $14.7 billion in revenue just in the last 3 months. That total was up 26% year over year. In the US, Amazon is behind owning Alphabet and Meta platforms in the industry, something most investors might not realize. Perhaps the most exciting part of the equation is the cloud division, Amazon Web Services. While growth here has slowed due to macro headwinds, the industry leading Salmon boasts a quarter 4 operating margin of 30%, and AWS gives Amazon a major avenue to introduce artificial intelligence innovations to its client base. Pay the price. It's not difficult to convince someone that Amazon is a great business. The facts speaks for themselves. It's no wonder shares have soared 8,300% in the last 20 years. But even at a market cap of almost $1.9 trillion today, it still makes it for a worthy investment candidate. That's because Amazon shares trade at a price sales multiple of just under 3.3 right now. Even after the stock soared 113% since the start of 2023, its valuation is about in line with its trailing 10-year average. Paying that price for Amazon looks like the right move. This business possesses numerous competitive advantages that give me confidence in its ability to thrive far into the future. It has a scale and logistics footprint that rivals can't match, particularly when it comes to better serving its customer base. And even more importantly, Amazon continues to develop its data advantage. There are very few companies that can collect the massive amounts of data from its customers like Amazon can. Management can constantly find ways to glean insights that better drive marketing and product development efforts. Investors have reason to be even more optimistic, though. After years of aggressive capital expenditures, executives are now focused on creating a more efficient organization, cutting costs across the board. Years of aggressive capital expenditures, executives are now focused on creating a more efficient organization, cutting coast across the board. This means that Amazon, which saw its operating income surge to a 2% in 2023, could see accelerating bottom line gains. And this can propel the stock even further. Now it looks like a good time for prospective investors to add Amazon to their portfolios. You got Salesforce here. Mm, Berkshire Hathaway. Okay. Well, what will Berkshire next move be? I wish I knew what Buffett's next move will be, but I don't. And speculating on what companies he may be interested in, given his financial horsepower, would be irresponsible. What I can say is that in this euphoric casino-like market, Buffett is keeping his cards close. Pretty apropos for him. The more important theme here is that through a series of successful investments, Buffett has built a strong balance sheet, one that gives him a level of flexibility most money managers envy. Despite the markets trading at record high levels, Buffett is doing what he always does, avoiding the gamble and waiting patiently, only to emerge with a sweeping cheese move when the market's least expected. Instead of studying Berkshire's portfolio and trying to identify the next company Buffett may take a stake in, I play things differently. Buying shares in Berkshire is a good option for investors who are seeking Buffett-like returns versus desire some insulated risk. Moreover, building a position in Berkshire automatically provides exposure to all of Buffett's strategic choices, but in a passive way, given the rock-solid reputation of Berkshire, coupled with the fund's jaw-dropping long-term returns. I see now as a great opportunity to scoop up some shares before Buffett makes his next move. We have Advanced Micro Devices, Axalis. Okay, let's read this one. A Sirius XM, one of Berkshire's choice. Hmm. America's only satellite radio provider was one of three U.S. stocks that Buffett bought during the fourth quarter. Warren Buffett took control of Berkshire Hathaway in 1965 and began stuffing its portfolio with shares of publicly traded companies and businesses it controls. Investors of all stripes watch Buffett closely because shares of Berkshire Hathaway have delivered a 4,121,700% returns since he took the helm. A major component of Berkshire's strategy involves buying exceptional businesses at a fair price to hold over long periods. Last year, Berkshire did more selling than buying. But one of the stocks it enthusiastically acquired was Sierra Maxim Holdings, America's only satellite radio provider. Well, during the last 6 months of 2023, Berkshire bought 40.2 million shares of Sirius XM whole stock. So far, the investment isn't working out since the end of 2023. Uh, Sirius XM stock has fallen by 26%, which means you could get in at even lower price than Buffett. Let's look at what makes this stock attractive. See if it's a buy on the deep. Okay, so what makes Sirius XM a Buffett stock? Buffett famously approached business with economic moats that can hold back competition. Sirius XM must compete with traditional radio and online streaming services, but it's the only satellite radio operator authorized to operate in America. Satellite radio might not seem important if you don't regularly drive long distances. For millions of folks who do, Sirius XM is more than just a preferred option for talk radio, sports, and music. In many cases, it's the only viable option for its customers' preferred programming. That's how it finished last December with 31.9 million paying subscribers, or 33.9 million if you include potential self-pay customers who are sold in promotional period. As the only US satellite radio provider, the company had enough pricing power to raise monthly revenue generated per user by 16% since 2018 to $15.56 in 2023. Subscriptions aren't rising quickly, but neither are expenses because satellites tend to float around for a long time. So the acquisition of Pandora in 2019 aside, returning profit for investors is a top priority for SiriusXM. The company's outstanding share count has declined 17% over the past 5 years. The lower denominators supercharged modest net income growth and all earnings per share to rise by a healthy 45% since 2019. Berkshire Hathaway doesn't pay dividends, but likes to pay stocks that do. At recent prices, SiriusXM Holdings a 2.7% dividend yield. The quarterly payout has risen by 120% over the past 5 years, but the dividend is still well funded. The company needed just 32% of the $1.2 billion in free cash flow generated last year to meet its dividend commitment. So, all in all, about Deep being US only US satellite radio provider isn't nearly as strong of an advantage as it was just a few years ago. And streaming services such as Spotify are eating SiriusXM's launch. Spotify finished 2023 with 11% more monthly active users in North America than it had at the end of 2022. So there goes a competitor named Spotify, and Spotify even have more users than SiriusXM Holdings. Promotional subscriptions that come with new vehicles are traditionally uh, show SiriusXM acquires most of its pay subscribers. Unfortunately for SiriusXM, America's 5G networks are not robust even that fewer automobile manufacturers build vehicles with satellite radio hardware. The number of potential subscribers using paid promotions at the end of 2018 was 5.1 million. That figure plunged over the past 5 years to just 1.9 million at the end of 2023. The company's attempt to expand outside its satellite radio niche by acquiring Pandora in 2019 hasn't gone well. Pandora finished 2023 with fewer paid subscribers than it had at the end of 2019. SiriusXM is a profitable and trading a low multiple of earnings, but growth will be increasingly difficult to achieve as fewer new vehicles come equipped with a satellite radio hardware. Shares of set but profitable businesses can produce market-beating gains over time, but only if you buy them at extremely low valuations. Until the stock falls into single-digit earnings multiple, it's best to watch its story play out from a safe distance. Oracle, okay. Three surprise AI stocks headed for $1 trillion market cap. Oracle's Red Hot Cloud Services division grew revenue by 25% year over year in its most recent quarter. Taiwan semiconductor manufacturing should ride the semiconductor wave to massive growth. Airbnb is arguably more of an AI company than a travel site. Now let's go over to Yahoo Finance and see what articles we can read, okay? Hmm. What I'm going to do first is go to my portfolio and see what has gone down the most recently in the past couple of months. And at this point, Tesla has gone down by 45%, and it's the one that went down the most, compared to other companies listed here. Okay, one last article, and then I'm done. Okay. Okay. The one that I'm going to read is Shopify, because Shopify has always been my favorite, and it's been such a long time since I read about it last time. Um, just 2 months ago, I read an article and used about it like pretty much every day, but now I'm like, you know, hmm, just leave it as it is. Uh, if things go well, it's gonna go up anyway. Shopify. Yeah, green flags for Shopify's future. Shopify is seeing growth in key performance metrics. Its article was published on March 11th. Some temporary expenses are clouding even stronger growth. Improved efficiency are aiding profitability and cash generation. So recent challenges are in the rear view mirror, and Shopify is poised for continued growth. Few companies have been on wider rides over the past few years than Shopify. Since early 2019, its stock has been as high as $169 and as low as $19, and today it trades for around $78. The pandemic introduced a pull forward of business to e-commerce companies, and ensuing correction played a large part in the stock's performance. Only recently are things beginning to normalize. However, investors always need to be looking forward as past results are no guarantee of the future, and finding catalysts at Shopify that the market might be missing can be key to accessing whether it's a buy now. With that in mind, there are three reasons areas that are given flags for Shopify's future. Accelerating growth in key areas. Okay, Shopify generates the majority of its revenue from its merchant solutions segment by charging fees for transactions that takes place on the platform. In light of this, investors should keep an eye on two important metrics: gross merchandise volume and gross payments volume. Gross merchandise volume is the total dollar value of orders processed on the Shopify platform. The fourth quarter of 2023, Shopify reported a gross merchandise volume of $75 billion. This was a year-over-year increase of 23% and continued a trend of accelerating GMV growth. The story is similar for GPV, which is the amount of GMV that is processed through Shopify's payment system. Shopify also collects a fee based on this dollar amount. Top line results are stronger than they appear, controlling expenses and generating cash. Shopify reported quarter four 2022 revenue growth of 24%, which is consistent with the last several quarters. In its quarter first 2024 guidance, the company noted it expects revenue growth to be in the low 20% range. However, there's a caveat to their guidance worth mentioning. After spending years building out its own logistics network organically and through acquisition, Shopify decided in 2023 to sell its logistics business to Flexport. As is often the case, this sale has an impact on results. Excluding the impact of this sale, Shopify anticipates an additional 5% to 6% revenue growth in quarter first. The logistics business sales also impacted the quarter first gross margin guidance, which the company expects to be 4% to 5% higher, excluding this impact. Okay, my source uh, hurt. So today I'm done with it, and tomorrow I'll see you guys. Okay, see ya and have a good Tuesday. Not Tuesday, Monday night. Okay, see ya and bye bye. Have a good night.